Hello, this is session 7 assignment for Professor Zhang's class, Management 310. In this session, our assignment is to determine the cost of equity for three companies with varying risk profiles using the capital asset pricing model, CAPM. As an analyst for a venture capital firm, you must calculate required returns for investment evaluation and provide strategic recommendations for cost of capital management. The analysis occurs in a rising interest rate environment with compressed technology valuations. Here's all the companies, company A, B, C, and the market parameters are for the required analysis. We're supposed to calculate cost of equity for each company using CAPM, explain beta differences across the industries and business models, analyze strategies for cloud tech to reduce cost of capital, assess recession impact on required returns, and compare CAPM estimates to alternative valuation approaches. And I used AI to help me work through this problem. For using the driver framework, we start with D, which is define and discover. And then our initial objective is to estimate the cost of equity for the three firms where they're using the capital asset pricing model, which is required return equals risk-free rate plus beta times the market risk premium. We discovered that the beta for cloud tech was 1.8, the regional bank beta was 0.9, and green energy was 0.5. Cloud tech is full of high growth, regional bank is mature, and green energy is stable / regulated. For the R, I'm going to outline the analytical plan. First, we're going to compute cost of equity for each firm via CAPM, create a security market line, compare beta and cost of equity across the industries, perform sensitivity analysis, and discuss strategies for cloud tech to lower cost of capital. And then once we do that, we can move on to I, which is implement and run the Python code. And here's all our betas, 0.18 or 1.8 for cloud tech, and then the rest. The code explains how using the CAPM function and adding all the betas to get our expected results for each company. The cost of equity when performing this coding for cloud tech is 15.3%. Regional bank is 9.9%. Green energy is 7.5%. As we move on to the V portion of driver, we got to verify our results. When we compare it to industry premiums, or when we compare it to industry averages, the industry average for SaaS is 1.5 to 2, which is consistent with cloud tech. Banks typically run from 0.8 to 1 beta, which is consistent with the bank option. And then for utilities, 0.4 to 0.6, which is consistent. So when we validate our results, they are all consistent with what we got using the Python code. Let's move on to E, evaluate. Cloud tech offers a high beta, 1.8, which reflects volatile earnings, competitive market, but is sensitive to investor sentiment. The original bank has a moderate beta due to stable but clinical revenue, and green energy has a low beta, which means it has regulated prices and predictable demand. For the recession impact, market risk premium likely to increase, which raises all required returns. Cloud tech is most affected by this recession impact, and green energy is least. For the strategies to reduce cost of capital, we need to diversify customer base to reduce volatility, improve cash flows predictability, communicate long-term contracts and recurring revenues to investors, and consider strategic partnerships or debt financing to reduce pure equity risk. Reflect. CAPM provides a clear theory-based cost of equity benchmark, but assumes a single-factor risk model, and ignores idiosyncratic risk and changing market sentiment. For our final insight, in a higher for longer rate environment, managing beta through operational stability and investment communication becomes as crucial as financial leverage optimization. Um,